Hello and good afternoon to everyone. Thank you all very much for joining us today for the launch of the QCA's new Environmental and Social Guide. I'm Jack Marshall, Head of Policy at the Quoted Companies Alliance. I think we might have a few people online today who might not be too familiar with us. So just as a quick introduction, we are the independent membership organisation that champions the interests of small to mid-sized quoted companies in the UK. We represent companies that are traded across the main market of the London Stock Exchange, AIM, and the Aquis Stock Exchange, as well as the advisory firms that support them. As a member of the QCA, you get to have a say in all of our campaigns and policy work, including the likes of consultations. I think we responded to nearly 24 or 25 of those just this calendar year, so almost one every 2 weeks, and also get involved in projects like this one. We're going into the new year, we will be beginning the process of updating our family of guides, including our audit committee and remuneration committee guides and our board performance review guide, as well as for the first time issuing our brand new nomination committee guide. Outside of policy, we have a very busy event schedule to think about, and just to give you an idea that we typically run about 50 events a year. These include webinars like these, roundtables, dinners, lunches, workshops. These might be fund manager events or events with government ministers and the regulators. Our two flagship events for next year have just been announced. The QCA Annual Conference will be taking place on the 5th of June. And we already have senior officials from the FCA, FRC and London Stock Exchange due to attend. Many more will be announced in due course. The QCA Annual Dinner, another one of the big events that will be taking place on the 11th of September at the new location of the British Museum. And tables are already selling well, so please do get in touch if you'd like to take one up there. Just as a matter of order for this session, myself and the panelists will give you some background and a quick snapshot of the guide before we have some time, hopefully at the end for some Q&A. You can submit your comments and questions through LinkedIn on the events page, so please do keep those coming. Just before we go any further, I'd just like to say a few thank yous. The process to produce this guide has been a collaborative one, and I'd like to say thank you to all of those that have contributed, and in particular to those on the working group. So I just want to mention Louis Cooper, Bethan Noel, David Hicks, Caroline Chambers, Trish Tremlawton, Paul Johnston and Roger Lewis. I'm joined by three more of those members today that sat on the working group. Will Pomeroy of Federated Hermes, he very kindly chaired the working group for this project and also chairs our corporate governance expert group. Helene Winch, who is the Head of Responsible Investment at Premier Miton Investors, and Michelle de Jong, who's the Managing Director of Inspired ESG. So we'll get into the new guide in a second, but I should just answer the very important question of how do you obtain the new guide? Well, of course, QCA members can download a copy of the guide from the QCA website. The cost of the document is included in your membership. Members get access also to the QCA's new ESG regulatory tool, that sits separately to the guide and provides a useful summary of current regulation. And of course, members also get access to the QCA code and other guides for free. Non-members are able to purchase a copy of the guide through the QCA website for £280. So just before we get into the guide and explain a bit about what it sets out to achieve, I think it's important to set the scene and provide some rationale for why we have produced the new guide. As many of you on the call, I'm sure will know, both ESG and sustainability, whatever you want to call it, have both been around for a very long time. They're not new concepts. However, there has been much commentary in recent months and years about the two agendas and over their value and importance as well. Their prominence really seemed to reach a peak during the COVID years, in issues like climate change on the environmental side, and workforce and supply chains on the social side were really looked at with a much sharper focus. And during these years, some of the largest and most prominent investors, including the likes of BlackRock, emphasised the importance of ESG to their clients in their communications, highlighting the need for companies to deliver not only financially, but also to make a positive contribution to society, and the need to help tackle the global threat of climate change. And in financial terms, it was estimated back in 2020 that about 35 trillion was the total amount invested in sustainable assets, according to the Global Sustainable Investment Alliance. Now, some of this money has since ebbed and flowed, and there's been a bit of a rollback from some of these asset managers who have reduced their support for environmental and social issues, with some suggesting that this is due to the politicisation of the ESG term. And this has brought about a debate about terminology, and some have stated that ESG is dead, and this has sort of gained a lot of attention in the press. But despite this, there's little evidence in the field to suggest that ESG is actually disappearing from view. And you could perhaps argue that ESG as a term might be on slightly less stable footing, but environmental, social, and governance approaches to investing are still very much alive and well. And there's plenty of evidence out there to suggest that investors still put a strong focus on these issues. Just to highlight a couple, Alex Edmonds, who is a professor of finance and prominent speaker on this agenda, issued a report earlier this year titled Sustainable Investing, Evidence from the Field. And that was based on a survey of investors, and they found that environmental and social issues were either very often or often incorporated into stock selection. In our own research published last year, we issued a report that was of a survey of investors in small and mid caps, and that found that nearly 40% of those investors surveyed stated their belief that smaller companies were missing out on investment as a result of a lack of practice and reporting on ESG matters. And it doesn't look like any of these conversations are going to stop anytime soon. Certainly from a regulatory standpoint, I mean, looking back a few years, we've had the FCA issue TCFD aligned reporting requirements for main market listed companies, requirements for those companies to report on specific diversity targets as well. And from the government, we've had the mandatory climate related financial disclosure legislation, which applies to AIM companies with over 500 employees. And looking forward to the future, there's still strong signals that these topics and future regulatory developments will occur. Just last month, the Chancellor delivered her first Mansion House speech and signalled a clear focus on green and sustainable finance, with the likes of the UK Green Taxonomy, sustainability reporting standards for companies through the ISSB, and climate transition planning. It's important to note that many of the things I've just mentioned are typically targeted at larger companies, and what we found is that it's difficult for smaller companies to know what to do and where to go. So as part of assisting companies in this, we published the QCA Practical Guide to ESG in 2021, and that was really our first step in helping companies to develop how they examine and disclose their approach to ESG, but with the promise of issuing further guidance in the future. So why have we now updated the guide? Well, of course, a lot has happened since we last published the guide in 2021. Many of you know we updated the QCA code last year, and this included certain measures around environmental and social issues. And this guide, therefore, sort of seeks to help companies address these aspects of the new code. I've already sort of mentioned, there's plenty of evidence from investors around their needs and expectations and how these continue to form an important part of the investment process. And this might be down to a number of reasons. It might be due to the recognition that better management of these issues can help to reduce risk or even potentially enhance returns. It might be due to client demands that require asset managers to pay closer attention to these issues, and it might be due to investors' own regulatory obligations and demands that require them to issue disclosures on their own products or portfolios, and therefore they will need disclosures and information from their investing companies. Or in all likelihood, it might well be a combination of those factors. And generally speaking, in the last year, over the course of the last few years, there's been an increase in the level of volume of these expectations, and they've evolved over time. And we really sought to address this evolution in thinking by taking on board the views of investors, and in particular small and mid-cap investors, from our survey last year, where we asked these investors of their expectations of smaller quoted companies when it came to practice and disclosure on environmental and social matters. So just to quickly address, where does the QCA Environmental and Social Guide fit in? So this new guide updates and replaces the QCA Practical Guide to ESG. The first guide was really about helping companies take the initial steps to think about how they're positioned and the threats and opportunities that matter to their business. And this guide now builds on the previous version, taking into account evolving good practice and the results of the survey already mentioned. The guide seeks to complement the QCA codes much in the same way as our other guidance materials do on the likes of remuneration, audit, and board performance. And I should just clarify, actually, before I go any further, the eagle-eyed amongst you might have already noticed the change in name of the new guide and might be asking yourselves questions why the new guide is not called the ESG guide and where the G or governance element has disappeared to. And well, this is deliberate, as we believe that governance is sufficiently dealt with within the QCA code, with this guide therefore covering the environmental and social aspects. And also important just to state that the guide doesn't seek to override the QCA code, and nor does it create anything entirely new, but recognises that, of course, good governance is a fundamental part of managing environmental and social risks. So moving on to what is the QCA Environmental and Social Guide. So the guide has been developed by a group of experts for us with the intention of assisting companies, and in particular smaller companies, to manage and communicate their approach to material environmental and social matters. With this in mind, the guide has been split into 5 pillars, which I'll come on to in a moment, and each pillar sets out how it should be applied in practice and what actions are needed. And then across the pillars, there is a series of recommended disclosures to help guide companies and aid transparency in explaining each element. So the guide intends to outline an approach that is proportionate and workable for smaller companies, whilst ensuring that the key factors required by investors are addressed. What it does not do is extend the requirements of companies, but what it does do is help you to take ownership of your story and tell that with confidence. The guides can be used in many ways. You can use it to expand on companies' current disclosures by integrating the various aspects into their practices and explanations, such as in the annual report or on the website, or it can be used as a template to produce a separate ESG or sustainability report that might sit separately to those typical disclosures. The guide is principles-based. It doesn't present hard rules, but instead principles of good practice that companies can apply to their own unique organization. And really, the emphasis in the guides is that companies should view their approach to these matters as a journey and should feel confident and able to be straightforward and transparent on this agenda. And by that, I mean, it might be that a company considers that only a very small number of environmental and social matters are relevant to the company due to a business model or geographic footprint, and companies should be encouraged to communicate this. And in a similar way, if a company identifies that it should be identifying and addressing further factors, then it also should signal this. And what the guide is really about is encouraging openness and transparency in order to build trust. Just as a final note, it's important just to state that the guide doesn't refer to any specific legal, regulatory, or other requirements, and the company must establish for itself what its regulatory obligations are. We have provided a list on our website, which will be uploaded shortly, and that includes useful information on some of the key ESG related regulations that exist out there. So moving on to the pillars, and as already mentioned, we have 5 pillars within the guide, and these are corporate values, leadership, oversight and management, materiality, measurement and communications, and actions, outcomes and commitments. And so the panelists, I'm going to hand over to the panelists in just a second, and they will go through each of the pillars in more detail. But just as a quick summary, these pillars put forward principles for companies to consider to address the needs and expectations of investors, and also to help the company build its reputation and tell its story of your business more effectively. So now I'll hand over to Helene, the pillars. So over to you, Helene, to take us through the first couple.
Thank you very much, Jack. Everybody hear me okay? So just to introduce myself, Helene Winch, I'm Head of Responsible Investing at Premier Miton, and we participate in 2 sides of the QCA. So we are ourselves an AIM-listed company, and we report against the QCA code in our reporting. And on the other side, we're an investor in UK smaller companies, and so we read people's reporting. So it's interesting we approach this environmental and social guide from both these sides. As an investor, over the last year, we've experienced significant amount of ESG regulation. Firstly, the TCFD, which is the climate-related financial disclosure, and this requires us to look through our portfolio and report on these climate metrics on our website to our investors. So we need to see reporting from our portfolio companies. Secondly, the SDR, the Sustainable Disclosure Regulation, encourages asset management companies like ourselves to be clearer on which investments have environmental and social characteristics, very much aligned wording. And Both these regulations and other regulations are included in the appendix at the report. So moving on to these first two pillars that I've been asked to talk about. So the first pillar, pillar A, corporate values. The purpose of the corporate value, and this purpose itself, as you know, is included in Principle 1 of the QCA Corporate Governance Code. And this feeds through into the values and, as is discussed by the company, the agreed approach to environmental and social issues. This can vary from company to company. So it can be from managing the potential financial risk of an environmental and social issue, all the way through to delivering impact that's aligned to the environment or to the social side of things. We're not prescriptive in the report on how each company approaches this. This is up to yourselves to decide. These values and this approach should very much be disclosed in the annual report, and this corporate value should then cascade through the 5 pillars. Moving on to the second pillar, pillar B, leadership, oversight and management. This pillar focuses on the how. So how is the management going to lead to support the values and the associated approach to environmental and social issues? How is the board going to have oversight? And on the day-to-day business, how is it going to be managed across the workforce and including the company culture? This approach is usually incorporated into the corporate governance structure, and whether this is a separate committee, a sustainability, environment, or health and safety, or whether it's a specific topic that's the most material issue, depends up to you. Again, we're not prescriptive on this. Alternatively, many smaller companies may want to manage this additional environmental and social issues through an existing audit or risk committee. Again, this depends very much in the approach as you define in the pillar A. Any new topics may need a working group or support from an external expert, and then this can feed through to how the management and how the boards are informed. Companies should assess whether you have the appropriate skills in place to manage any new risks. Secondly, companies should have a process which enables them to raise issues and how to manage them. Metrics and KPIs are both really useful as part of the management information for monitoring as well as decision making, and through into the reporting in the annual report. This process and the management assessment of any environmental and social issues should feed through. Just to give you a quick example for a Premier Miton, I chair the environmental committee, and the issues that we've highlighted is the management of the climate change risk. This feeds through into the board oversight, and we have a board member who has climate change experience. We have experience throughout the organisation, directors, management, and we're supported by external consultants on this. And as an example of something that we've been looking at, the net zero strategy with progress on metrics has been discussed with the board, and this is fed through into the annual report, which will come out later this month. So that's a quick summary of the pillars A and B. And now we're handing over to Will.
There we go. Best unmute myself. Thanks, Helene, and thanks, Jack, before. Yeah, I'll briefly talk to pillars C and D, and just by way of introduction, as Jack mentioned at the outset, my name is Will Pomeroy. I essentially head up ESG engagement within the small and mid-cap equities teams here at Federated Hermes. There are two perennial debates, I think, within the ESG space over the last 10, 15, if not more years. They're essentially what terms should replace ESG. I think Jack's already covered imaginatively for this guide, we landed on ENS, but it nonetheless took up a good deal of time within the working group discussing that age-old question. The second piece is which and what ESG topics are material. And it's on this latter point that there's been enormous effort spent by various parties to determine and opine on what is material over that last decade or so. And numerous organisations have developed materiality matrices at various levels of granularity, for companies to adopt per their sector or industry. You can see SASB and GRI and many others as examples thereof. And in parallel, the term materiality has been baked into regulatory requirements for ESG disclosures across jurisdictions. Unhelpfully, the term materiality is defined differently across those different jurisdictions. So in one camp, there's the single financial materiality camp, which is very much that which dominates in the US and to a lesser degree here in the UK. And in the other camp, there's double materiality, where companies are required to consider both the environmental and social risks to their business, but also the impact of their business on the environment and society. Now, the European regulation very much emphasizes that double materiality piece. And at various times, those two wildly different concepts are argued to either be one and the same, or to be very much completely wildly different concepts. In reality, over a reasonable time frame, there's a large degree of convergence. Our guide notes that a company should determine the materiality for their individual business, looking at individual environmental and social issues, primarily through that financial lens. So appraising the impact upon the company's financial prospects, including, in particular, with respect to costs and revenues, including those that may arise via legal, operational, or reputational risks. Additionally, the guide does reference the multitude of external frameworks that I mentioned before, but very much tries to give the emphasis that those are reference points and not to be considered definitive one-size-fits-all frameworks to be applied by the company. Indeed, the emphasis is on the company taking a step back and ideally thinking through those issues themselves. So the guide asks companies to consider their own situation, reflect on what matters to them, given their own business model, their geographic footprint, and their strategy for growth. And equally importantly, the guide does encourage companies to give consideration to the impacts of their activities towards external stakeholders. This additional lens, we believe, will help companies identify those topics that might not be financially material today, but may become so in the not too distant future. So engaging with key stakeholders is self-evidently an important element of the process. Therefore, we argue that appraising materiality will involve a mix of both quantitative and qualitative analysis. The materiality of every issue cannot be defined or evidenced, rather, by backtesting alone. Indeed, relying on such an approach risks imposing too strict a filter. The risk would be identifying those topics that were material yesterday and missing out on those issues that will be material in the years ahead. For example, many, if not most, climate transition or physical metrics would be considered immaterial for possibly all sectors if we looked on a quantitative backtest. But looking forward, I think we know as carbon becomes increasingly, the cost of carbon becomes increasingly internalized, there will be commercial opportunities for many as well as cost to bear for others. So materiality analysis needs to be forward-looking, incorporate projections, and likely factor in different climate scenarios. Assessing materiality will therefore ultimately produce highly individual results and should be reassessed from time to time, likely on a 3-year basis. In terms of disclosure, the guide simply asks companies to explain what process they've gone through to identify those issues considered to be material. How was materiality defined for that purpose? And most fundamentally, what issues were identified as being material for the business itself and why? Personally, I'd encourage companies to be as forthright as they can feel comfortable being, explaining both why those issues identified as being material for it have been identified as such, as well as why it has drawn the line where it has. Because having a self-confidence about the process and the conclusions will allow the company to communicate confidently and also to push back on requests from stakeholders, including investors, to cover ever more issues going forward. And then more briefly, just on the measurement and communications pillar. Now, this is potentially the most straightforward pillar in the document, if those other aforementioned elements have been undertaken thoughtfully. An obvious conclusion of identifying a topic as being material to a company's prospects is to identify how management of that issue is then best monitored and tracked. So the communication thereof should seek to explain why these issues are important to the business, how they're connected to the financial health and prospects of the business looking ahead, and where within the business, to Helene's piece earlier, there is oversight of the management of that topic. And that will include, going forward, a discussion as to the degree to which the board and the audit committee in particular has had oversight of the reporting of the topics, and the degree to which there's been a level of assurance provided over the reported data itself. It's important to communicate both what's been assured and to what level, and what has not, and indeed who has provided that level of assurance. The sustainability assurance market itself is very much in a state of maturation at the moment, and the FRC has just published its initial findings on a market study into that sustainability assurance market. And their one, I think, key conclusion, frankly, was that all stakeholders anticipate the demand for sustainability assurance to keep growing in the next few years. Finally, my just last couple of comments would be, there's an element of nuance that's conveyed in the guide, and Helene, I think, touched on this in her comments a moment ago, that there's the need to communicate both those topics that the company has identified as being material through the process it went through, but there's also a need, frankly, to identify those issues that investors consider to be immaterial, almost irrespective of the impact on the financial prospects for the business. And climate change, as Helene touched on, are absolutely kind of front and center of those topics. Investors themselves are coming under increasing regulatory requirements around the measurement, communication, and reporting of climate transition, carbon footprinting metrics, and the like. And therefore, the need for corporates to be providing the disclosure that investors can both appraise and ultimately cascade down to their investors is growing too. And that's very much the sort of set of metrics that I think Jack was alluding to in his survey of corporates and investors earlier this year, where corporates risk essentially being squeezed out of the investable universe of investors by dint of, frankly, providing metrics that they can and perhaps ought to be providing, but just don't consider to be important and relevant to their business currently. And then my very final message would be, to consider all of this communication an opportunity. This is the company's opportunity to flesh out, essentially further, its equity story. So own that story, explain why the matters that matter do matter to you and should matter to investors. Explain how the risks are being adequately managed and the opportunities are being lent into. Provide both the quantitative disclosure, but also the qualitative disclosure too. So ultimately aim to be explaining, measuring, and contextualizing. And I think investors will be very receptive to that. So on that point, I'll pause, shut up, and hand over to Michelle.
Apologies, I was still on mute. Thank you very much, Will, and thank you for everyone for making time to join us today. So just to give a brief introduction about myself and Inspired, a bit similar to what Helen was saying in the beginning, as Premier Mitten, Inspired ourselves. We are both a quoted company on the AIM market, so we hit most of, well, frankly, all of the reporting thresholds that quoted companies on AIM are captured by. And us as a business at Inspired, we then support our client base with their transition to operating within a low carbon economy. So as a business for ourselves, we both understand what the challenges are to meet the disclosure requirements, and what does that mean from an internal process point of view. So the change management that businesses have to adopt to ensure that their operations are effective and that they have the right people in place to enable them to report against the various regulatory requirements. And then as a business unit ourselves, or particularly my business unit, supporting within the ESG space, the rest of the group is quite uniquely placed, whereby the traditional side of our business is all around energy procurement. So helping our clients with their energy procurement strategy is essential when it comes to their wider environmental disclosures. And then also we have our engineering division, which is our optimization division, which is our team that goes and implements those solutions on the ground for our clients. So what we get from that side is we get to see what the potential costs are going to be with their wider energy efficiency programs or the decarbonisation solutions they're going to be introducing across the short, the medium, and the long term. So I've been asked to talk about Pillar E, which is the actions, outcomes, and commitments. Perhaps most probably from just coming from the perspective from client side, most probably in any of disclosure requirements, the area that a lot of clients perhaps feel a bit nervous around because they're quite apprehensive of perhaps, as Will was mentioning earlier, perhaps having to over-disclose, being asked to over-disclose, setting targets based on information that they feel they might not want to put out into the market just yet, or are they setting targets on the data, and the quality of the data might not be up to standard, because data issue is a wider challenge within the space as the sector itself matures and as businesses themselves look to once again improve their overall operations. So to sort of set the scene when it comes to the actions, the outcomes, and the commitments, and I think the guide does this very well in pointing report preparers and those all involved, because it's not just the report preparers who have to really digest the guide. It is the wider stakeholders in the business making up the different departments who need to understand what they need to be providing to the report preparers in order for the report preparers to prepare the disclosures. But it's taking that step back and understanding the wider landscape. So first and foremost, from an action and outcomes point of view, a business needs to ask themselves, well, where are we, and where are we in the wider macroeconomic landscape? And as Jack alluded to in the beginning, this is very much based on geography. So the requirements, if you're listed over here and only within the UK market, are X. However, if you're operating in other European markets, your requirements are going to be Y, as Will was touching on around the aspects of double materiality. So where you are located and what the wider drivers are really are going to shape how you're also addressing your targets. And then the next question one has to ask themselves, which once again the guide does point to and allude to it with enough detail to really to grasp of going, well, what is material to the business, as this has really been touched on. So when you're setting wider targets and how you're going to be reporting against those targets, it's essential that you're reporting against what is material to your business. And ideally, the way we approach this is separating it into two wider camps. So one, what are the opportunities businesses can capitalize on as we transition into a low carbon economy? Because that is the macro context that we're all operating in. So are we going to land up in a 1.5 degrees scenario, 2 degrees scenario, or are we going to be well above 3 degrees? So understanding that wider environment is essential, and also understanding what are the opportunities that presents to your business. And then counter to that, we're also looking at, when we're setting the targets, is what is the risk mitigation. I wanted to focus a little bit more on opportunity in the beginning, because we talk so much about risk and risk mitigation and regulatory pressures in order to mitigate against risk, but really for companies to identify and sort of capitalize on the opportunities of what the regulations are providing for business. It's really that focus of moving away from just focusing on risk, but really looking at the opportunities. So when we're structuring our targets, we really need to understand that in the context of the various time horizons, as we already touched on, with that forward-looking analysis that will shape how you're setting up your targets. So what are we looking at in the short term? So that's usually between two years to 5 years. That's essential from an investor perspective to understand, what is sitting on the balance sheet, and what are the risk-adjusted returns, what are the regulatory adherence, the financial obligations of the company, enabled to deliver, and what's the overall strategy. And then when you're looking at the medium to the long term, and that's when you're sort of looking further out, where those longer term climate risks are, we need to be considering how we're adjusting the business model to be able to mitigate against them, but also to capitalize on those opportunities as the market itself evolves, or the economy. So when we're setting our targets, and if we use the example as the guide highlights, which is looking at your emissions. So once again, now we're looking at our natural capital and then looking at our human capital aspects. A good example of that when you're setting your targets is, one, you need to be setting targets that align with the business strategy and that are achievable. Targets don't also just mean of what you're putting out to the market of, well, we're going to reduce our overall emissions by 20% by this date. It's also targets are looking at, well, how are you changing internal processes to ensure that you have the capabilities internally to reach those targets. And this we sometimes find, from supporting a lot of businesses in this space, is that not enough focus is perhaps given to the amount of change management that has to take place within the business itself. So other key things to look at when you're setting the targets, and as the guide also alludes to, is understanding that the geographical target. So, for example, within the UK, we have 2 dates that we need to be adhering to, which is our 2030 target date and our 2035 target date. So that gives you a good guideline of what's your direction of travel and the expectations that the government has and the regulators will have on us as businesses, but also that helps to really focus in, well, what do we need to do and what actions and steps we need to be taking in order to make sure that we are aligning our businesses to meet those overarching targets. And then the other key aspect when it comes to the targets itself and the commitments, and it's been touched on before, but it is really essential to it, which is that G that underlines everything. So we actually arguably say everything starts from the G, because it's, without strong governance, you're not going to drive any of these aspects through around social and environmental. But it's understanding what your management processes are and what's in place. So once again, that's really pointing to the change management that businesses need to be focusing on. So who is responsible for what? Who within the business has the capability or knowledge and understanding in order to implement what needs to be implemented within the business itself to make those changes. And then finally reflecting on who is ultimately responsible for signing that off, and that needs to be presented within the disclosures themselves. And as Helena had mentioned in the beginning, from a board perspective, you might be tagging on to existing committees, or you might be setting up a separate committee altogether. But ideally, what we like to look at is really focusing more on the opportunity side around environmental and social reporting, how businesses can capitalize on the wider opportunities as we transition ourselves into a low carbon economy, and look at, well, what we're doing in terms of making our buildings and business processes more efficient, and how do we then upskill our existing employee base to be able to meet the changes that will happen to our businesses, and to ensure that they are sufficiently skilled for those future jobs. So from that side, we find this whole part of the sector itself quite exciting, and the guide itself, really just highlight how companies, providing examples of what companies could be reporting against, as what we're seeing is, wider best practice in the marketplace. So just to make sure I'm not overriding on time, I'm going to hand back to Jack.
Thank you very much, Michelle. Thank you for that overview, and thanks as well to Helene and Will for taking us through the pillars of the guide. We're going to go into Q&A now, so please, if you are watching, please do submit your questions. We've got a couple already, but it would be great to get a few more in. Michelle, I'm sorry, I'm going to pick on you first. I know you've just finished talking, but you and your colleagues have helped us pull together. You and your colleagues at Aspired have helped us pull together this new tool that's going to sit on our website and will be launched very shortly. And that provides sort of a breakdown and outline of some of the key regulations. So perhaps you could just briefly explain a little bit more about that.
Yes, so I think the biggest challenge that a lot of companies have is really understanding what they're getting captured by and what is the overlap between the different regulations. So the purpose of the tool is for companies to put in the key metadata of the organizations, and for then them to understand what they are captured by, and understanding what the crossovers are. So by understanding what your regulation requirements are, you're able to go back to your internal stakeholders and right, we have Regulation A, which might be your streamlined energy and carbon reporting. It's been around for a couple of years. That's looking at your operating emissions, your scope 1, your scope 2, and then your grey feed. Then you might also be captured by the energy savings and opportunities scheme, which is looking at what opportunities within your estate you're capitalizing on to making it more energy efficient itself. And that's key, because your investors want to know how much money you're going to be ring fencing to investing into these solutions, and what is going to be what's the payback, and what's the return, what's going to be the return on that investment. And then you've got your climate related financial disclosure, so that's really looking at that wider risk piece, but they all overlay each other. And then, as we said, as you had mentioned, to the emerging regulations we're having in the UK, which we know they're going to be publishing next year, which is the UK's iteration of the ISSB's S1 and S2, which is UK SRS. So apologies to everyone for the acronyms. Then the UK's version of the taxonomy itself, and then perhaps you might even be tipped into the European regulations, and those are quite a lot more aggressive than the UK regulations. So really understanding where you sit in the regulatory environment is essential to what you need to be focusing in the business, and particularly from human resources, and how then you're communicating with your investors of what plans you've got in place to ensure that you're compliant, but also really highlighting those opportunities that are presented to your business and to your sector with the changing environment.
Brilliant, thanks, Michelle. And yeah, you're right. Just remembering all those acronyms is a challenge in itself. So thank you. Will, I'll come to you next, and more of a sort of general question. As an investor, how important are those environmental and social issues? Do you think they will continue to play a prominent role in investment decisions, or do you see those as sort of diminishing importance? Obviously, we both mentioned there has been some debate already, and the election of Trump in the US is probably only going to add further fire to that. But how are ESG matters sort of material to the investment decision process?
Yeah, absolutely. I think just on the last point about Trump and politicization of ESG, I think it's very obvious now that there is a kind of twin track approach to ESG, and certainly communication around it on the two sides of the pond. And certainly here at Federated Hermes, we are owned by a US company. We very much look into and lean into, and are very cognizant of some of the challenges around ESG currently, and certainly certain ESG topics in North America. I haven't seen much evidence of any of that, frankly, trickling across the pond to European and UK companies. And certainly with respect to us as investors in companies, the importance of ESG matters has been important for a long time, and is certainly not diminishing in this current climate. And indeed, for all the reasons that Michelle has touched on from a regulatory perspective, and from the kind of increasing demand and interest from our underlying clients, that materiality to us of material E, S, and G topics of the companies we're looking at is growing kind of frankly quarter on quarter, year on year. So it's hugely important both for the individual stock selection process that typifies all of our small and mid-cap investment teams here at Federated Hermes, as well as the portfolio construction, the ongoing monitoring of, and ultimately the decision to continue to hold individual companies within those portfolios. And one of the points obviously we made during the discussion a moment ago was that increasing burden that frankly is flowing down through investors to small companies to disclose a number of metrics that may or may not be material to their business. In particular around that climate piece, that's almost a hygiene kind of element of disclosure that companies need to be making, irrespective of the materiality to their individual business at this stage, given the kind of pressures that flow up from underlying investors in our funds that ultimately then flow through to the investees that we're invested in.
Thanks, that's brilliant. And Helene, how do yourself works for an asset manager? What do you look at environmental and social considerations, and what do you want to see from the company, both in terms of its practices and what they're communicating to you? What does it need to demonstrate? What do the companies need to demonstrate to you?
Thanks, Jack. So I think for us, it's a lot of it is around the due diligence that we take on companies before we invest. So meeting management, meeting the boards, reading the annual reports, and the same way that we will look at financial numbers to understand what's going on, we will very much look at the ESG side of a business as well to see whether, is it consistent with the financial side of things, to see that there's demonstration that these risks are being considered and measured appropriately. And as we've heard, I think it's focusing on the most material risks that we don't need a 400-page annual report. We just need the most important risks and to see that they are being picked up. And it's that recognition from management and through the board that they're aware of what are the biggest risks. It's a shame really that so much the focus is on the climate reporting. For many companies, that's not the biggest report, yet you have to spend a lot of time reporting on that. And I think that for some smaller companies might detract from maybe managing the social risks better or managing kind of governance as well as it can be. So I think it's having that confidence of understanding where your risks and opportunities lie and aligning and flowing the annual reports proportionally to that. But they are questions that we will continue to ask. And it's something we're really interested in how companies articulate to us as well.
Will, you unmuted yourself. Did you want to jump in there as well, or?
Yeah, I think I really just wanted to endorse Helene's comments about, I think most people when they think about sustainability, think about climate and kind of all the debates and discussions around TCFD and TFND and all the other umpteen acronyms that are out there that frankly put people off engaging in the whole agenda. And I think it's exactly as Helene said, for most companies, the most salient material ESG topics are in the social dimension and frankly around the corporate culture and human capital management. And what we want as investors is companies to talk about what matters to them in a way that resonates with investors, i.e., what is making that company a successful company today and over the next 5 to 10 years. And if it's not all of those nature environmental topics, don't spend 10, 20, 30, 40 pages talking about them. And in so doing, completely diluting the stuff that is ultimately more important to your business and the message you want to convey.
Brilliant. Yeah. Well, I think the summary from all of that is that materiality is really key to all of this. So that's one takeaway that's important. Michelle, when you nicely sort of framed your discussion of the pillar around opportunities as well as identifying the risk, and surely smaller companies are going to have a really important role to play. In the UK, globally, helping transition to net zero, helping to develop the products and services that can address society's problems today. They're surely going to have a key role to play in that.
Yes, I mean they are. I think it's. I think what's really important, what we do need to focus on, and I think everyone who's been in the space for long enough will agree, is to sort of move it from this idea of when we're talking about the E and the S, that it's compliance, because compliance is just an aspect of what we have to do for business. It's really looking at, well, how are we considering the E and the S when we are running our businesses? And that's essential, for the investors to understand, well, do you have the right staff who can carry the business on? You have the right the right succession planning in place. Are they appropriately skilled? Do you have the right environment, leading to culture, leading to wider governance practices? And it's in order, we don't know how many new jobs are going to be coming to market in the next 10 to 15 years as we're pivoting into this new world order that we're all a little bit unsure of when it's going to land, how it's going to land, the tensions between, for and against. So I think if we sort of pivot the conversation away from it just being compliance, but and really bring everyone, the internal stakeholders, along on the journey in terms of within the business to understand, well, how does this make your part of the business better? So going to HR and saying, okay, so let's talk really about the social aspects within our own workforce, but what do we want to work on? Well, what do we need as business? What are our forecasts? How are we going to be making our workforce better? How are we going to be positively contributing to their experience at work as well? And vice, when you're going to talk to the procurement team, okay, how are we engaged with our suppliers? Who's really at risk? Where are we not getting information? Do we need to diversify more? And I think when you're sort of talking about it from that point of view and you sort of slightly move away from the client compliance aspect, because what we've noticed, as soon as companies perhaps dip just below the compliance bit, they just want to stop and they want to peel it back. And really that's, I mean, we understand the point that, because they're just seeing it still as burden and compliance rather than just let's look at the benefit. How are we adapting our businesses and making them more successful for the future? And what are those opportunities out there in terms of what are the gaps in the market that we need to service? And I'm sure both Helen and Will agree on this, is that this is what investors are wanting to hear and wanting to see in the reports. And really, what's the opportunity there?
Yeah, brilliant. And yeah, great, for companies to explore these opportunities in development, but at the same time, and not to be put a down on it, greenwashing has become a theme in recent years as well. And Helene, it's obviously important, that companies explore these opportunities, but at the same time, they're not overemphasizing their green credentials, and particularly sort of asset managers and the rating agency have all closer scrutiny and attention now around greenwashing. Companies need to do the same, surely.
Yeah, no, completely. That's exactly what I was thinking. I can agree with kind of what Michelle was saying, and those opportunities from these smaller companies, which are going to become bigger companies and are going to provide the solutions both on the energy transition, but also, to kickstart the growth in the UK. But yes, it is all about being clear, fair, not misleading when you're illustrating what you're doing in your annual report and to your investors. And again, I think this is what the guide should help companies do. And if you start on that first pillar in the kind of corporate values and allow your vision to flow through the pillars and through your annual report, then that should stop you from doing any sort of greenwashing. But it's always worth just thinking, can I evidence this statement? Am I saying too much here? Am I providing kind of too much focus on the good environmental benefits I'm providing without fully disclosing that same amount of detail on maybe some of the harm I'm creating? And it's getting that balance. But very much we want to see both sides. We want to see really good articulation of the opportunities that companies see and the opportunities they're chasing, but also risk management of those risks that are there in the businesses as well.
Certainly. And obviously, we have to be mindful that there's always this notion that more and more is required, and the debate about how the quality of data and disclosure and the information that's provided, and we're talking typically about smaller companies here. What can companies do if they can't get access always to data? There must be a balance that can be struck in some way.
Yeah, I think that's obviously right, Jack. I mean, one of the hopefully core messages of the guide is investors are after quality, not quantity. And clearly, I think most certainly active investors are very mindful, in particular in the small and mid-cap space, that there are challenges in gathering some of that data, getting it kind of in the necessary reporting infrastructure internally, and then ultimately communicating it externally. Therefore, the message I think we're hopefully conveying, and did convey originally back in 2021, is don't wait to get all that data in the perfect shape before you begin telling the story. Start telling the story today, and it can be an iterative, evolving story over time. What investors want to get is, to Helene's point earlier, confidence that the management team and the board have frankly wrestled with the topics, identified what matters, is managing it as appropriately as they can do at this point in time internally, and through the communications effort, conveying that level of reassurance to external investors. And that absolutely goes to the risk piece. And I said, do try and quantify to the extent you can, and then contextualize and explain what that data point means, but also to the opportunity. There is an increasing demand from underlying investors as well as from regulatory actors to be incentivizing investment in solutions of varying different guises. And frankly, most investors in sustainable investment funds want to be supporting the solving of environmental and social challenges. And therefore, there is a need for companies to be conveying that and to be quantifying their impactful revenue base in that effort too. And that's certainly something that is in the gift of companies that too often they're not quite doing today.
Thanks, Will. Michelle, you did unmute yourself. Did you want to add something to that?
Sorry. Yeah, I just want to echo a little bit of what Will was also saying. And data is always going to be an issue, and the expectation in the space is that companies will need to be restating all the time. That's just part of the process as the guidance improves and as companies with themselves improve their processes. But I just wanted to highlight one thing, particularly for small companies, and perhaps just something as a reflection point of, the idea is that there's almost three aspects of what needs to be understood within the reporting spaces. That those governance structures we've been talking about, so those business processes. Then you've got to have someone internally who is sort of coordinating the process itself. And then it's also that understanding of what Helena was pointing towards, is that technical knowledge, particularly also at senior level. And these sometimes, I think what happens in smaller companies like ourselves is that the idea is, okay, we just get one person and we consolidate that all into one role. And that is quite ambitious to find one person who's going to be able to do all of that. So it's really understanding that it's not just the reporting, but it's what do we have to do from a process point of view, how we're looking at what's the investment we're doing over there, what we invest in terms of human capital to organize and coordinate that, and then how we're building up expertise, and whether you do that internally or bring someone else in, or you have this conversation. So I think separating that out is also really helpful for businesses to understand, because then they don't land up over-investing in the beginning, or perhaps starting on a good track record and then deciding to reshuffle things, and they land up going backwards. So it's just something to bear in mind. I think is important, particularly for smaller companies like ourselves.
Definitely. Thanks very much. So we're very nearly out of time. We're bang on 2:00. So just a final reminder, really, that members can download a copy of the guide for free. That's live on our website at the moment. Of course, QCA members also get access to our other guidance materials and the QCA code. Non-members, you can purchase a copy of the guide for £280. Or become members and get a copy of the guide for free, along with lots of other benefits. I've already mentioned our brilliant events lined up for next year: QCA annual conference and our annual dinner, which will promise to be both great events. So do get in touch if you're interested in either of those, or if you'd like to come on board as members. But that concludes the session today. So all that's left to do is thank everyone for attending. And again, to Will, Michelle and Helene, thank you all very much for presenting. And I'd like to wish everyone a good rest of their day. Thanks very much.
Thank you.